As a business owner, you have to prepare to be sued. You have to go into it with the idea that you are going to be sued. Hopefully you're not sued, but there's a very high probability you will be sued, and you need to prepare for that. This video is going to talk about some of the mistakes that people make that can make it easier for someone to sue you and make it easier for someone to be successful if they do sue you. Mistake number one is that they commingle funds. Their personal funds and the LLC funds, they treat as if they're the same. Ultimately, those LLC funds, that profit will be yours, but you cannot live out of the LLC. You need to make sure all of the income for the business goes into the LLC bank account. You need to make sure that all the expenses are paid from the LLC bank account. If you buy groceries out of the LLC bank account, you have made a huge mistake, because now there's really no distinction between you and the company. It's your alter ego, and that makes it easy for someone to pierce the veil of your company and go after not just your business assets, not just your LLC assets, but against your personal assets. You create an LLC to limit your liability, but there's a trade-off. The state requires you to maintain that LLC as separate and distinct from you. If you do not keep yourself separate from the LLC, then you will be held accountable for those LLC liabilities when they arise. That will defeat the whole purpose of setting up an LLC in the first place. So quickly, all the income of the business should be made payable to the business and should be deposited in the business bank account. That's number one. Number two, all the expenses of the business should be paid from the LLC's bank account or the LLC's credit card, with the LLC's credit card. Number three, always record transfers from the members to the LLC. So a contribution to the LLC or a loan to the LLC, always make a record of those contributions and what those contributions are. Have a meeting minute for all of those contributions. And then finally, all of the distributions, all of your removal of the profits, your pay, whether it's as a salary, whether it's as an independent contractor, whether it's as just a member distribution, you should have a record of those as well. That makes it very clear that you are not one and the same as the business. It will also assist you when you're doing your taxes, when you're working with your accountant. What was this? This money came out, this money went in, what were they? You will have really good meeting minutes that create a formal record of all of those movements of money. All the things that I just went over require you to have a business bank account. It's a absolute. You must have a business bank account, an LLC bank account. We have partnered with Relay Financial, a great company that has created a platform for doing your business banking and doing it in a way that really helps make it easy. See the link below for more information about Relay Financial. The second biggest mistake people make when it comes to their LLC, and this applies to multi-member LLCs, is they fail to agree to how contributions will be addressed. What are the initial contributions that the owners, the members, are going to make to the company? Are they making a cash contribution? Are they making a contribution of intellectual property or a vehicle or a piece of real estate? Or are they sweat equity? Are they going to earn their equity over time in the company? People fail to come to an agreement on these matters about how those contributions will be treated and then what percentage of the company's profits that's going to entitle them to. It often comes up when there is one person who is very well heeled, right? They have a lot of money, and the other person, the other partner, does not have a lot of money. One person's putting in the cash, the other person is going to earn their percentage of the company through sweat equity, they often call it. And that can lead to problems down the road. It's very, very important to create a record of the contributions and then what happens when the LLC at a later point in time, if something doesn't work out, how are those contributions going to be divided? People also, when it comes to contributions, do not account for the fact that they may need to put in additional money in the future. So you think things are going to work out well, each person puts in an equal amount of money in the beginning, 6 months down the road, the company needs more money. Are you required to put in additional funds as a partner? What happens if you don't? What happens if you don't have the ability to put in more money? Do you get a reduction in your ownership interest? Is it treated as a debt to the company? So you have to work out these things in advance. And the place where you do it is in your operating agreement. Failing to have an operating agreement that has details about contributions, when you need to make them, how they're accounted for, is gonna cause you big problems down the road. The third mistake, and this one is so critical, not for you, but for me, is that you don't like and subscribe. So please like and subscribe to this video and make sure you stay up to date on all of our content and new videos as they come out. That's really not mistake number three. Mistake number three is that the members fail to have an agreement on how someone gets out. What happens if one of the partners no longer wants to be a partner? One of the members is no longer interested in the business. One of the members moves away. One of the members dies even. And they do not have an agreement on how that departure will be handled. Can they leave? Can they sell their membership interest? Is the other member obligated to buy them out? That's often the case with junior partners. When you've got one person who's a 10% owner and someone, say, a 90% owner, there may be the majority owner must buy out the other individual. So you need to have these things figured out and agreed to in advance. The most common way is going to be address it in your operating agreement. But you could also have a separate, called a buy-sell agreement. That is a rider effectively to the operating agreement. You keep your operating agreement simpler in that way, and then have this addendum, this additional agreement that covers situations where somebody wants out of the partnership. Failing to think about this in advance, thinking that it's all going to go perfectly well and everyone's going to be in this business forever, really opens you up to a huge opportunity in the future for a dispute, for member unhappiness, and for potentially the total dissolution of the company. The fourth mistake that I very frequently see is that people fail to sign their operating agreement. The operating agreement are the rules of the road. It really is very important to make sure that your operating agreement represents the will of the members. If you don't have an operating agreement, then you're going to be held to the default rules that are published by the state, that are in the limited liability company statute. You may not like those rules. And so it's very important to sign your operating agreement, make sure everyone understands their rights in the operating agreement. And if you watch the next video, we're going to talk more about operating agreements, get into the details of what they include and why they're so important.